Good morning. My name is Aman Chugh, and in order to visit my detailed profile, you could visit www.amanchughca.com, which is amanchughca.com. This audio is getting recorded on 6th of February 2018. And I thought that with this audio, I could also share with you certain images which shall be helpful for you to understand as to where the market is behaving. Ideally, I have always advocated that a portfolio should always be balanced and should have a right mix of the right product, along with certain products which are risk-free. Because ideally, while the portfolio has got different investments which are risky, the risk-free investments should also be a part of the portfolio to bring down the risk so that in the times when the markets are really bad, the risk-free investments are able to at least take you through the rough and the tough times. Well, ideally, bonds and equities are normally said to be inversely relationship holding with each other. Ideally, people believe that if the bonds are moving up, which means the interest rates are falling or the yields are falling, because yield and bond has got inverse relationship. So if yields are falling and the interest rates are expected to fall, the bonds rise, and when the bonds rise, it is expected that equities fall. And vice versa, when we have a feeling that the interest rates or the yields are about to rise, which means the bonds fall and equities normally rise. Hence, till now, for the last 20 years, for the last 2 decades, the world believed that bonds and equities are normally inverse. And however, the phase is that investments in bonds and equities are both falling due to the inflation going up. So while inflation is going up and inflation growth is expected to be overcrossing the growth of the GDP across world, I'm particularly talking about US, UK, Europe as well. So due to which the bond yields are rising, and US bond yields, UK bond yields, Europe bond yields are rising, which means that the bonds value has been falling, and also the equities are also falling, and this is happening for the first time in the last 2 decades that both the asset classes are falling due to expectations of inflation exceeding the GDP growth rates. Till 2018 December, the market was in a risk-on mode. So risk-on means that market investors, traders, speculators are willing to take the risk in the market, and risk-on mode is there. However, now the market has moved into a risk-off mode. So during a risk-on mode, everyone would love to have their over-leveraged positions or over-exposure towards equities, and during risk-off mode, people tend to move out of equities into bonds. So ideally risk-on and risk-off mode. However, while risk-off mode means that people tend to move into bonds because they believe that in risk-off mode, bonds will help them to generate returns and also to protect their portfolios, because equities would not be performing when there is risk-off mode. But presently, while there is risk-off mode in the market, still the bonds value is also going down while the equity market's value is also going down. And this is happening for the first time in the last 2 decades, in the last 20 years. Hence, the rules of managing wealth and portfolios are changing and need to be changed. That means whatever conventional methods of portfolio management or financial planning we had learned or we were trained upon, I think now we need to re-exercise and rebalance our skills on portfolio management and financial planning. Almost 70% of the bond holders across world have sold off their holdings. To be very precise, it is 69% of the bond holders who have sold their bond holdings, and they expect a bigger crash in the bond markets in the times to come because inflationary trends are moving up and are expected to be crossing the figures of US GDP growth rate. Also, US debt has been increasing, and it is expected that while Mr. Trump is ruling, he expects it to continue to increase the debt by USD $1 trillion every year for infrastructural purposes. However, while this whole of debt which he will pump into the market to push the infrastructure development in the belief that while the infrastructure gets developed in the market in US, later on it will lead to better production and better growth in the economy, but that will take some time for the growth to flourish further by more faster pace. But till then, because of extra burden of debt and extra pumping of money, this is leading and this would lead to further pressure on inflation. Further pressure of inflation would mean that bond yields rising further and bonds value crashing further. So ideally, this would mean that values of bonds will further go down, and while the inflationary trends are rising up, that will mean that many companies in US will have a challenging situation to handle the prices as well, and that would mean that unless and until those prices are passed upon to the consumers, which is quite tough because there is no massive demand, there is no massive growth which could exceed the inflationary trends as of now. This would mean that equities would also crash and bonds would also crash, and this is what is happening. This has already led to almost 30 to 40% fall in the top rated corporate and sovereign bonds because of the growing inflationary trends and the growing yields in the bonds. And you could see that almost 30 to 40% fall in the top rated corporates and the sovereign bonds across world is further going to deteriorate. And debt to GDP has already increased for almost all of the world from 70% to 110%. In my video, I think video number 1 or 2, you would have already seen, and I had already stated the figures that the increasing debt to GDP ratio for almost all the world economies is quite creating quite a challenge. And in this video number 5, I would rather say that this situation is further getting aggravating. There is also a further challenge that emerging markets do not know how to refinance their exposure, and hence there is a quite lot of challenge on the refinancing challenges for the EMs, which is emerging markets, on the existing debt positions which they have to on which they have to make the necessary payments. So they do not know how do they refinance their existing debt positions. And US budget deficit has also been increasing, and while the expectations of US budget deficit was around $700 billion, it has increased to over $1.2 trillion. And it's a huge deficit for US, which is putting pressure on dollar again. In 2008, 2010, 2011, 2015, the yields had fallen off and the bonds had rallied to offset the destruction in the wealth in the shares. So ideally, in these years, while in 2008, there was a massive destruction of over $10.5 trillion worth of equity market. But because of the bond yields falling during 2008, I think the bonds yield had fallen from 4.25% to almost 2%, which had led to almost 4 trillion worth of positive cushion on the bonds. Similarly, in 2015, there was a destruction of equity market in US by almost $4.5 trillion. However, the yield had moved from 2.5 to 1.3 on bonds, and which had provided $2 trillion of positive cushion from the bonds. Similarly, in 2011, there was a negative trend by almost $3.7 trillion on the US market capitalization. But because of the bonds yield rallying from 3.5% to almost 1.7%, it provided a rally on bond positive cushion by almost $2.5 trillion. Similarly, in 2010, while there was a destruction of the US equity market by almost $2.5 trillion, but the bond yield had moved from 3.9 to almost 2.9, which had led to almost $2 trillion of a positive cushion on the bond side. However, in 2018, which is now 17-18, there has been already a destruction of almost $3.2 trillion worth of equities, and the bond yield has also been rising. So it is not decreasing, which means the bond yield has risen from 2 to almost 2.9, which has led to an additional $1.5 trillion of wealth destruction in bond market as well. Which means for the first time in the last 20 years, the portfolio is getting imbalanced because equities are also going down and bond is also going down. So ideally, this shows that the rules of portfolio management across world need to be changed, because if US goes through these type of tensions and US market faces this type of blues, I think all the economies, including India, should also be knowing as to how a portfolio should be rebalanced, refinanced, so that the conventional mechanisms of parking your money in equity and debt funds, because both will offset each other, is not a good rule now. So hence, the bond yields rising as of now has led to further additional wealth destruction, and which is happening in Indian economy as well. So while the Indian economy's equity has also fallen from almost 11,200 of a Nifty to almost touching a 10,200 of a Nifty, and presently hovering at around 10,300 or 400 of a Nifty, while there is a market destruction on equity side in Indian economy as well, but the bonds value has also deteriorated because of the massive rise in the yields of the US of Indian government bonds as well. Hence, I think it is necessary for each one of us, whosoever is related to finance or financial planning, we need to understand how scientifically this could be managed, and this should be managed, so that new learning mechanism should come. I'll be again coming up with my further video or audio along with data. And in case you have not seen my previous videos on YouTube, I would request you to see them, so that you are able to connect the connection. And in case you have not pressed the subscribe button on the YouTube, I would request you to do so, so that the further videos or audios are easily accessible to you. In the meanwhile, you could also save my 9999300216 number. And if you wish to receive the audio on your WhatsApp message as well, or probably the various messages which I send on the WhatsApp groups, you could pass on your details on this number, and I could add you to one of the broadcast list. Thank you very, very much. I hope the information is getting beneficial for you, and I would request you to further float this audio and video amongst your friend circle, amongst your colleagues, so that the whole of the economy comes to know that what is happening across the world. Thank you very, very much.